Hello everyone, I'm Ali, and in this video we'll look at the different phases of an audit. The three main phases of an audit are risk assessment, risk response and reporting. This figure provides an overview of the three phases of the audit. In the risk assessment phase, the auditor gains an understanding of the client and financial reporting framework, identifies factors that may impact the risk of a material misstatement in the financial report. The auditor also performs a risk of material assessment and develops an audit strategy in this phase. In risk response phase of the audit, the auditor performs detailed tests of controls and substantive testing of transactions and accounts. In reporting phase, the auditor evaluates the results of detailed testing and forms an opinion on the truth and fairness of the client's financial report. ASA 300 requires that the auditor must plan their audit by developing an audit strategy. The audit strategy sets the scope, timing, and direction of an audit. It also guides the development of the audit plan. A well-planned audit ensures that the auditor gathers sufficient appropriate evidence for the accounts most at risk of material misstatement. This figure shows the elements of the preliminary risk assessment phase of the audit. During risk assessment phase, an auditor obtains understanding of their client, identifies related parties such as parent companies, subsidiaries, joint ventures, and associates. It is the responsibility of the auditor to ensure that the related parties are identified and disclosed appropriately in the financial report. During risk assessment phase, auditor also identifies and evaluates the risk of material misstatement due to fraud and whether it is appropriate to assume that their client will remain as going concern. A client's corporate governance structure is also assessed by auditor during this phase. Auditor also obtains an understanding of client's system of internal controls. During gaining an understanding of their client's system of internal controls, the auditor also considers the impact of information technology. Auditor also identifies the significant accounts and classes of transactions when planning the audit, so they can make sure that adequate time is spent testing these accounts and classes of transactions. During this stage, the auditor also considers the adequacy of clients' closing procedures and the associated risks. Now, we will be looking at some of these elements in details. According to ASA 315, at the beginning of every audit, the auditor must gain an understanding of their client, the financial reporting framework, and the client's system of internal controls. As a result of risk assessment stage, the auditor will need to gain an understanding of the entity's organizational structure, ownership, and governance, and its business model, industry, regulatory and external factors, measures used to assess financial performance, applicable reporting framework, and how inherent risk factors affect the susceptibility of assertions to misstatements. The auditor also assesses whether the entity's accounting policies are appropriate and consistent with the applicable financial reporting framework. In gaining an understanding of the client, the auditor considers issues at the entity level, the industry level, and the economic level, or the economy level. It's important that an auditor gains a detailed knowledge of their client. The auditor gains knowledge about the entity through interview with key personnel of the entity, including those charged with governance. The auditor will ask questions about what the entity does, how the entity functions, and its sources of finance. For a new client, this process is very detailed and time-consuming, whereas for a continuing client, this process is less detailed and involves updating the knowledge gained on previous audits. By gaining an understanding of the client, the auditor is in a stronger position to assess entity level risks and the financial report accounts that require closer examination. The auditor gains an understanding of the applicable financial reporting framework. A financial reporting framework is a set of criteria used to determine measurement, recognition, presentation, and disclosure of material items included in the financial report. As all financial reports are prepared in accordance with the financial reporting framework, it's important that an auditor identifies the framework applicable to the audited entity at the beginning of the engagement. The next element is major consumer. The auditor identifies major consumers of the entity and consider whether those customers have a good reputation or on good term with client and are likely to pay the client on a timely basis. Dissatisfied customers may withhold payments, which affects the provision for bad and doubtful debts and the client's cash flow. Over even they can decide not to purchase from the client in the future, which can affect the going concern assumption. Major suppliers. The auditor identifies major suppliers to determine whether they are reputable and supply quality goods on a timely basis. The auditor can also pay attention whether significant level of goods are returned to suppliers as faulty, if there is any contract with the suppliers. If there is, what are the terms of the contract? The auditor also considers what are the terms of payment to suppliers. The auditor assesses whether the client pays its suppliers on a timely basis. If the client is having trouble with its suppliers, it may have trouble sourcing goods, or suppliers may refuse to transact with a company that does not pay on time. Whether the client is an importer or exporter of goods is identified. If the client trades internationally, the auditor considers the stability of the countries the client trades with, the stability of the foreign currency and the client trade-ins, and the effectiveness of risk management policies the client uses to limit exposure to currency fluctuations, such as hedging policies. The client's capacity to adapt to changes in technology and other trends is assessed. If the client is well positioned to if the client is not well positioned to adjust to such changes, its risks falling behind competitors and losing market share, which is in longer term can affect the going concern assumption. The nature of any warranties provided to customers is also assessed. If the client provides warranties on products sold to, then the auditor needs to assess the likelihood that goods will be returned. The auditor also needs to assess the risks, whether the client has under-provided for that rate of return. This means the auditor needs to ensure that the provision for warranty account is not understated. The auditor also reviews the terms of discounts given by the client to its customers and received by the client from its suppliers. The auditor does the assessment of the client's bargaining power with its customers and suppliers to determine whether discounting policies are putting profit margins at risk. Because if this is the situation, then it may place the future viability of the client at risk. An assessment is made of the client's reputation with its customers, suppliers, employees, shareholders, and the wider community. A company with poor reputation places future profits at risk. It is also not in the best interests of the auditor to be associated with a client that has a poor reputation. The auditor will obtain information from where the client operates, the number of locations it operates in, and the dispersion of these locations. The more spread out the client's operations are, the harder it is for the client to effectively control and coordinate its operations, increasing the risk of errors in the financial report. The auditor will visit locations where the risk of material misstatement is greatest to assess the processes and procedures at each site. For example, an auditor is more likely to visit client operations if the client opens a new large site, or if the business is in a country where there is a high rate of inflation or where there is a high risk of theft. The auditor obtains an understanding of the nature of employment contracts and the client's relations with its employees. The auditor will consider how a client pays its employees, the mix of wages and bonuses, the level of unionization among the workforce, and the attitude of staff to their employer. The more complex the payroll system, the more likely that error can occur. When staff are happy, there is greater risk of industrial action, such as strikes. So when staff are unhappy, there is a great risk of industrial action, such as strikes, which disrupts the client's operations. The client's sources of financing are reviewed. An assessment is made of clients' debt sources, the reliability of the future sources of financing, and reliance on debt versus equity financing. Auditor assesses whether their client is meeting interest payments on funds borrowed and repaying funds raised when they are due. If a client has a covenant with a debt provider, the auditor will need to understand the terms of that covenant and the nature of restrictions in place on their client. The client's ownership structure is assessed. The auditor is interested in debt funding relative to equity, the use of different forms of shares, and the different rights of shareholder groups. The client dividend policy and its ability to meet dividend payment payouts or operating cash flow are also relevant to the auditor's understanding of the client. The auditor will also assess the client's reliance on IT. Some companies have a very high or a very heavy reliance on IT, while others have a modest reliance on IT. The companies which rely less on IT requires less focus during the auditing, whereas the companies which rely heavily on IT, the auditor need to place more focus during the audit. The auditor gains an understanding of the client's, the entity's system of internal control. According to ASA 315, there are 5 components of an entity's system of internal control: the control environment, the risk assessment process, the process to monitor system of internal control, the information system and communication, and control activities. The auditor obtains the understanding of these 5 components in details. We'll be looking at these components in details in the next videos. At the industry level, the auditor is interested in the level of competition in that industry. The more competitive the client's industry, the more pressure placed on the client's profit. In an economic downturn, the weakest companies in highly competitive industries face financial hardship and possible liquidation. Therefore, a key issue for an auditor is their client's position amongst its competitors and its ability to withstand downturns in the economy. An auditor also considers their client's reputation relative to other companies or competitors in the same industry. If the client has a poor reputation, customers and suppliers may shift their business to a competing firm. As a result, threat may arise to clients' profits. In such circumstances, the client's management may resort to aggressive accounting choices to improve their profits or reduce their losses. The auditor can assess their client's reputation by reading articles in the press and industry publications. Auditor also considers the level of government support for the client's industry. This issue is important if the industry faces significant competition internationally or industry is new and requires time to become established. An assessment is made of the impact of government regulations such as tariffs on goods, trade restrictions and foreign exchange policies on the client in the industry in which it operates. Regulation can affect a client's ability and continued profitability. An auditor will consider the level of taxation imposed on companies operating in their client's industry and the impact this has on profit. The level of demand for the goods sold or services provided by companies in the client's industry is also considered. If a client's products or services are seasonal, this will affect revenue flow. So, for example, if a client is a swimsuit manufacturer, sales would be expected to increase in summer. However, if the weather is unseasonal, profits may suffer. So, furthermore, if a client operates in an industry subject to changing trends such as fashion, the client risks inventory obsolescence if it does not keep up and move quickly with the changing styles. Economy level. The auditor assesses how economy level factors affect the client. Economy upturns and downturns, changes in interest rates and currency fluctuation affect all companies. An auditor is concerned with their client's susceptibility to these changes and its ability to withstand economic pressures. During an economic upturn, companies are under pressure to perform as well as or even better than other competitors. Shareholders expect consistent improvements in profits in good times. So during this kind of environment, when auditor is conducting audit, the more focus is given to overstatements of revenues and understatement of expenses. Whereas in case of economic downturn, companies may decide to take a bath. This means that companies may purposefully understate profits and overstate expenses because when the economy is poor, there is a tendency to maximize write-offs as a fall in profits can easily be explained to the share market as most companies experience a decline in earnings. When auditor is conducting the audit where the economy is in recession and clients may be tempted to take a bath, more focus is given to the risk of understatement of revenues and overstatement of expenses. And in the next video, we'll talk about the evaluating fraud risk. Thank you.